What's up, everybody? It's Jadu and Jonah of The Cash Compound, and we're here to talk about a couple of money myths, a few things that are going to help you get to the place where you can crack the code to cash flow. That's what we do at The Cash Compound, is we help the financially foolish or fit, just like you, get control of their money, build wealth without ever locking it up, without ever giving up control, and without taking on any risk. So today, what we're going to chat about a little bit is misconceptions around life insurance. So, Jonah, there's a lot of people, including ourselves, and that's what I want to talk about a little bit first here, is who really don't understand life insurance at all. And we talk to folks in some cases who have a little bit of knowledge, maybe a lot of knowledge, but there's plenty of the American or North American population, as we deal with people in U.S. and Canada, who are just unsure about how it works and what's going on.
Yeah, that's absolutely correct. So we wanted to tackle just some, like Jeremiah said, just common misconceptions about what's going on in life insurance. And so the one that we thought we'd tackle today and put our 2 cents in is that life insurance is bad.
Yeah, first off, it's bad. And why would it be bad?
Yep. Absolutely. So I think for me personally, one of the things that I run into the most is that people just aren't taught about what's happening inside of life insurance. Why they get it. It's crazy to me that they're so familiar with car insurance and phone insurance and house insurance, whatever else it might be. But when it comes to life insurance, they're going, oh, I don't need that. Or oh, my parents got it covered. I've heard that. I've heard all sorts of crazy stuff. And so we want to tackle that today. We want to chat about that today. We want to tell you and show you exactly why we think a little bit differently than this very common myth about money and life insurance.
Yeah, so first off, I got to say that there are plenty of people in the last few years, including myself, who've figured out I actually need that cell phone insurance. First off, right? The first 8 phones that I had, I didn't get it. Why would I need that? Then after you start cracking those nice phones you paid $1,000 for, then you're like, go ahead and tack on that Apple Care or whatever it is that you know. So you start to understand that life insurance covers a loss.
Right.
And in life, there will be a loss. You have to die. So here's my first question for you, Jonah. I might actually know this question, but I have to pose it to my co-host here.
All right.
Did your parents talk about life insurance?
Well, maybe you didn't know at home, but our parents are the same. So our parents did not talk about life insurance. And I'm not sure if it's because it's a weird conversation to have, maybe to talk about what happens after you're gone, or you just don't want to talk about death. I'm not sure, but no, life insurance was not a at-home subject taught in our household. And so because of that, like lots of other folks, you kind of have to pick it up as you go and learn from some of the other outside factors that are kind of influencing the decisions of what you do as an adult and as a professional. So,
and I would say in our household coming up, there's 8 years between us. So some of our experience is slightly different, I would say, just because there's a generation gap in there a little bit, is the reason it didn't get brought up was ignorance. It wasn't because they were trying to avoid a hard subject. And I know plenty of people actually now that it's weird if you want to bring it up because they aren't emotionally understanding the future. They don't understand you got to die. Like it's not actually a negative statement. Literally, the way the syntax of the sentence is, you have to die, is positive. If you don't have it, you say don't, that's negative. So you do have to die. Let's make sure it's not a negative emotional event when you do for your family. So here's my question for you. Before we got into this business, helping people and getting them out of debt, helping them recapture their cash flow, getting money back for cars and that type of thing, what was the catalyst for you to first learn what life insurance was?
Sure. So in a previous role, in a previous job, I actually was a banker. And so I started really getting my hands involved in a lot of aspects just about money. Started to learn about finance, started to see where people were putting their money and what they're spending it on and things like that. And so I think maybe through influence of another person or just the communication with another person just kind of got me to realize that there were other insurance options in the world and just other things that I really need to know about. I really need to learn about. So I remember reading and learning about personal finance, about how much money I should be saving every month, where I should put it, why I should have debt or not have debt, tackling that, things like that. And so at one point, I just remember literally Googling, I'd even challenge this to you guys at home, literally Googling how much it costs for a funeral if you die. And so when I saw that number,
Do you remember what the number was? What was the range? How long ago was this?
So I definitely Googled it, particular to our state. So we're in South Carolina here. And so I think it's somewhere between 12,000 and 15,000, if I remember correctly. Now, it might be higher now. I haven't Googled it recently. But I remember seeing that number, and I thought to myself, well, I mean, if I can go at any time. Everybody knows that. So who's paying for that?
Because I'm his big brother. I ain't paying for it.
Right. Who's paying for that? And then I started, I mean, I let my brain sometimes go off on a tangent. So I started thinking, well, I like to go, do stuff and hang out and road trip and travel. So what happens if I die in Georgia? Like, it has to be higher because they have to get my body home and stuff like that. So I started to realize that, and I just went, I should pay attention to this. I should have a plan in place. I should have life insurance for that funeral expense, that final expense. And so that's really when it kind of turned me on originally to understanding, okay, I need to look into something that's got to do with life insurance.
So I agree with you completely. I got called by a financial advisor, which I think is one of the second misconceptions or myths about dealing with insurance, is that it's something that's sold generally by the door-to-door salesman or your brother-in-law. And a lot of people are, they put up guards if they think someone's getting paid for a service. We have no problem going to Walmart and making sure the Walton family gets paid.
Sure.
But if our friend comes to us, or an acquaintance or friend's friend calls us up, and they might get paid, someone who lives in our community, is a part of our economy, who potentially has a good thing, product, service to help us, all of a sudden you throw up walls. Now, I was broke enough and upset about it during my experience in growing up years that I'm ready to answer the door for anybody who comes around. Because, look, I'm sick of being broke. There's got to be things out there that some people know that our mom never told us.
Sure.
And it's not because she didn't love us. It's not because it was hard to talk about emotionally. There's a lot of just ignorance out there. That's what I think it was in our family specifically. So let's talk about that a little bit right now. Another myth is that sneaky salesman, that person that that might get a commission, and if they're going to get paid for what they do, they're bad or something like that. You know people like that, right?
Absolutely.
We've got friends who don't participate and practice the wealth building that we teach people, because if we get anywhere near them and try to tell them what we do, or they think they know already, it's evil, because you'll get paid.
Sure. I mean, I agree with you. It's just a really common misconception. I've learned kind of as an adult that some of the best products come from people who have to sell them for commission. And I've really started to realize that as an adult. But back to the insurance thing. I mean, that entire industry, if I'm not mistaken, I mean, it's really based on a lot of door-to-door and just face-to-face sales. And so those people can sometimes, not all the time, but sometimes set up products maybe that are above your need, or kind of push you into something that maybe you don't exactly need, or just above the threshold that you actually did need. And so I think because of that, they got a lot of a bad rep. And
that's anything.
Yeah,
and that's anything. Like you said, I've figured out in my adult life that all these vacuums, the legit ones get sold door to door, right? The ones you bought off of, I'm calling out Walmart here. Maybe I'm going to call out Walmart every episode we do. Those ones are not the nice ones. The nice ones are the ones that are potentially the most expensive and get sold by individuals.
Sure. Yeah, absolutely. So, I mean, realistically, I think that all salesmen are not out to get you by any means. And I think that the ones that truly take care of you really do provide the best service, the nicest service. And a lot of, and again, a lot of the insurance industry is done door to door and face to face and things like that. Our entire business is based off of word of mouth. It's only based off if you
referrals,
think we did a great
people
job.
Who want to work with us. We don't call on people, cold call.
Yeah, absolutely. It's only based off if you think we did a great job and provided a great service to you, which we try to do with every single person that comes through the door. We want to help them. We want to give them the advice that we needed when we started. We
Right.
want to show them
Yes.
exactly what we're doing and how to do it, and to do it effectively. So,
And I think that's another big thing, because we only teach in our specialized industry here. We teach, we educate, and we only do things we actually do at home.
right.
People ask us on the phone all the time, well, what would you suggest? Well, literally, this is what I did,
Yeah.
or this is what I will do,
Yep.
or this is what I have for my family. So it's the whole thing about a vacuum. Do you think the vacuum salesman doesn't have a vacuum? My man has a vacuum. Like, he's selling something that's worth it. You know what I'm saying?
Sure.
Yeah,
Yeah,
he has one of these vacuums.
Yeah, I hear that all the time, especially when I talk and help with our members, and they ask about paying back loans, or they ask about getting a second policy. What would you do? So I hear that all the time. A second policy question is one that I've actually gotten like a lot recently. Well, if I get a second policy, do I put it on myself? Do I put it on a family member? And legitimately, I always answer with, well, what I did when I started that second policy is that second policy went on my wife. Why? Now you probably know our punchline. We're going to use our policies for banking.
For cash.
But
Boom.
if I'm going to have two policies for banking, don't I also want two death benefits? I want one on myself so that my spouse can get that death benefit if something happens to me. And I also want one on my spouse so I can get the death benefit if something happens to her. I mean, that's just natural, right? It's like killing two birds with one stone. It's satisfying that need for the final expense if something were to happen, but also giving you the ability to bank with the policies. So that's a question that I get all the time, and I always answer that way. And then they say, okay, what about the third one and the fourth one? And I say, got any kids? Got any grandkid? Whatever it is. So that's a question that I get all the time, for sure.
So here's the third kind of misconception or myth, is we've heard this term referred to these people before. The people who get on the airwaves mostly and are financial entertainers, we've heard that term, that someone else told me, AKA Susie says, Dave says,
Sure.
Don't go for whole life. Now, if you don't know about what we do, we teach people how to never lock their money up, never take on any risk, and never lose control, and utilize guaranteed, uninterrupted compounding growth with dividend-paying whole life insurance from mutual companies. So talk about the misconceptions about whole life and what people are starting to learn in other places.
Sure. So I've heard that a lot as well. And one of the biggest common misconception is that those other folks are not talking about what we are doing. It's actually kind of funny. If you truly do follow these other people, you'll even see it. I've seen literal posts on social media. I've listened to the radio shows. I've seen the videos where they're legitimately telling you, if all you're going for is that final expense category, the death benefit, then do term insurance. And realistically, I'd tell you the exact same thing.
I agree with that.
If all you want is that final expense, go get term insurance. And you can use their folks and do all that. We don't do it. But what we do is set policies up for banking. We use whole life policies in banking, and those other folks just aren't talking about that. And so it makes it seem like, oh, your product, we shouldn't use your product. We should stay away from your product because these other folks said to stay away, but they're not talking about what we're talking about. And in fact, we agree with them on the point that they're making about the product, because if you're only looking at one aspect of it.
Right.
So, yeah.
So, yes, we help people understand the living benefits, the properties of utilizing money while you're alive. So literally, and a reminder, you can't get your death benefit. So if you've got a policy built on yourself, which most of us start off with, most of us do, us included, you can't get the death benefit. That's for other people.
Right.
We never get on the phone and talk about that with people. We remind them that will exist for their spouse, their friends, their church, their foes, their charity, whatever. But we're talking about using your money today, because there are banking properties that are available to you from day one in what we do.
Right.
So a couple of things. If you go to, so I went to DaveRamsey.com right here, and I mention him because he has, in the last 20 years, become the biggest, loudest mouthpiece for not doing whole life, for doing term only, for salesmen are trying to outsell you,
Sure.
get commissions off stuff. And you got to understand a few things. That the misconceptions here that he's got when I'm looking on his website are things about that cash value.
Well, first, I think they need to understand that we're not trying to hate on this particular person, and his debt payoff plan and program has a significant impact on our life, because our parents did that growing up.
I did it. 100%.
Right. And we've gone to his classes and read his books.
Yes.
I've got them. And I'm not trying to say everything that he says is not true.
So get out of debt. Stop using third parties to finance all your stuff.
We agree with that.
100%. We're not out here using credit cards to buy things. That we are not. I would say stick with. If someone doesn't know anything about finances and their like number one goal is to get out of debt, I might, which I have done before, give them Dave's book. Start here just so you get out of the mud. Right. But we're going to utilize our money as an asset throughout our life. And we're going to teach you, as we say in our presentation sometimes, how to save and spend money at the same time. Right. So we're going to get you out of debt. We're going to save you from those problems, and we're going to still use our money. The point isn't to save our money. The point is to utilize our money properly. So you can do that with what we do. So a reminder, because one of the myths inside people's brains that might come from a guy like that is saying things about you lose your cash value when you die.
Sure.
How would you talk to someone about that? Wait. So when I die, the cash value goes away and I don't get anything? I mean, I heard that this weekend on the phone. What do you say to people like
Sure.
that?
Well, first, you're dead. So what were you expecting to get if you're not here anymore, right? And understand the death benefit is going to be a bigger number than the cash value, and that goes to your beneficiary, whoever you chose, right? Church, friends, family, charity. So it's kind of, I've heard it too. It's kind of crazy. They're like, oh, I lose the $5, and I'm going, your kid got 1,000. What are you complaining about the $5
You're dead.
for? Right, you're gone, and your beneficiary's got all the money. So normally you just kind of have to explain that. Explain it to them that, no. The money that you're talking about losing is little, and yes, you lost it, but you're gone. So the bigger money is coming for your beneficiaries, and that's what they get, and they can spend it and do everything they want with it.
And people have got to realize that what we're going to teach you from day one and the way we engineer policies within the cash compound is you get to use all of the money that you've put in, the equivalent amounts, and more while you're alive. So you don't lose anything.
Right.
You put in $20 over the course of 20 years, you're going to be able to use $30. So what do you mean you lost money? You got all your money back, as we like to explain to people in like the car examples.
Sure.
This is how you spend money and get all of it back, and you can use it. And then on top of that, your kids, will not be crying at your funeral, so you're going to have to teach them like, hey, act sad, because you about to inherit a lot of money when I'm gone. So, so those are a lot of great things here. What about the myth of being able to utilize? Just talk a little bit more specifically, because we touched on that. I just did, about utilizing the money. Most people don't utilize their cash value well.
Sure.
And I think the main reason is because they don't have a lot of cash value.
Right. So here's the key. When you're talking about a banking policy, you've got to have this policy designed appropriately. It's got to be designed for banking. If you go down the street to your everyday life insurance guy, your brother, your friend, your roommate from college, and you say, I want a policy, a whole life policy, they're probably going to design it the way they were taught, which is the way of death benefit, final expense. So they might know how to put a little bit of cash value in there, but they just don't design it for banking like we do. So the problem is, if you have a policy like that and you're being coached like that, that's widespread of your cash value starts small and rarely gets any bigger. It goes very slow, things like that's where the misconception comes from. With our policies, the way that we design them purely for banking, which means purely for cash value. That's what we're designing the policies for. So your cash value grows over time. Like Jeremiah just said, you're going to put in a certain dollar amount. Let's just call it $1. You're putting $1, and they're going to give you back more than $1 to be able to use over time. And we're going to teach you how to use it. Go do something with it. Go have fun. Go pay off bills. Go buy new stuff. Whatever you want to do.
Use it. Use the money.
Absolutely. Use it. But it's just different. Sometimes I like to refer to it like this. I use this just recently. Everybody understands car insurance. So I want to make a quick analogy to car insurance. If you've got car insurance, let's say you've got State Farm,
okay,
and I've got Allstate, okay? Well, you've seen my commercials for sure with the Allstate guy, and he says...
And I'm Jeremiah from State Farm, so you've seen my commercials too.
Right, the khaki pants. He says that if you drive safe over here at Allstate, every 6 months you'll get a safe driving check. right? And at State Farm, they say if you drive safe, every 6 months, they'll lower your deductible.
Right.
Well, understand that if I'm with Allstate, I can't get that State Farm ability. That's particular to that company. He can't get my Allstate ability. He doesn't have the company, right? So there's different aspects within the insurance. There's also, understand there's different additions to the insurance. With his State Farm policy, he can opt in for towing. He can opt in for rental car. He can opt in for full coverage or liability, whatever he wants. You can design a policy appropriately.
And that's going to manipulate your premium.
Yeah. Exactly.
Manipulate the cash.
Understand with whole life insurance, it has all of those available options as well. Well, not those available options, but it's got options.
Towing. You get towing.
You can't get towing on your body, okay? But it's got available options to you as well. So if you don't know which options to deselect,
right,
which options to select, then you're not going to put together a policy that produces cash value like we want it to produce cash value for banking. And so if you are not taught how to do that, or you're just
right. It's not all the same. We've got liability, we got comprehensive, we got towing, we got all those things, and they're different. Right. Maybe for your phone, it's basically the same. As long as you don't drop it in the toilet, we'll reimburse you if you lose your phone.
Yep.
But on car insurance, it's different. And life insurance is the same way, because there's other types of life insurance, right? So we didn't explain that much, but of course there's term, which is like renting. Whole life is like buying, because there's equity or cash value. And there's universal, index, and all those other things. Now, we specifically use one type for one reason, and it covers the needs of all those other things. It's not an investment. It's not, there is money available.
Yep.
It's going to pay out no matter what. Because I think another misconception that that is out there is you could lose your money. Like, nobody has ever lost money, ever. 200 years, whole life insurance, nobody's ever lost money.
That's right.
And sometimes people had one this weekend. I was chatting through, and they got started with their own banking system. But wait, you can lose your money like if you stop paying. That's not losing your money. That's being stupid. So I didn't lose my money if I stopped paying for my car insurance.
Right.
I had coverage while I paid.
Right.
I just discontinued paying.
That's exactly right.
So it's a big thing there. So any other thoughts that we have for people and misconceptions about life insurance? I think a lot of people out there don't realize that life insurance for 200 years has actually been, in the last 2 or 3 generations, more and more misunderstood, probably because new products and policies that were attached to the market and had a lot of risk attached to them, what we use and what we know banks use, what we know some of the largest companies use, doesn't have risk associated with them. So people have gotten way off on what it can do for you. And the biggest thing that I think our great-great-grandparents understood, not ours specifically, because I also think there's a racial divide in there for a lot of people, is that it can help you build wealth.
Sure.
They just don't understand that there's a wealth building component to it. And we can leave money to the next generation. And we can do this by circumventing the tax code. That's a huge thing. Why don't you talk a little bit about that, with tax advantages, misconceptions about how it works, the fact that, hey, you can utilize this without bringing Uncle Sam into the picture.
Sure. So there's kind of 2 aspects when it comes to that. And the first is that when you take cash value out of your policy, we're always going to encourage you to take that out in the form of a loan. Loans are not considered income in the eyes of the IRS. So therefore, on all that cash value growth that you're going to get and be able to take and use, always taking it in the form of a loan means that you won't have to worry about tax implications. As well as when your beneficiaries get the big final expense death benefit there at the end, that also is an insurance payout. There's no tax implications on that. Same rules apply for the car insurance. If you, God forbid, crash your car on the way home from work, you don't have to pay taxes on the check that you get to go get the new car, right? It's an insurance payout. So that'll be the same for the beneficiaries as well. Now, there are some stipulations around it where if you follow exactly what we're telling you about banking, you'll never run into them. But if you go with some of these other policies, some of these other setups, some of these other guides, whatever, you could run into some tax implications. And if that's happening to you, unfortunately, you're just in the wrong spot for banking policy. You need to talk to someone who specializes in banking policies like we do. So
All right, ladies and gentlemen, that concludes our episode today of talking about a couple things in the money myths and misconceptions category. We're talking about life insurance, what it is, how it works, and how we can help you with your banking. So keep checking with us on Facebook, on Instagram, YouTube, as well as inside our Cash Compound courses. We have an entire library of course material that you can check in with us. Go to thecashcompound.com, check in with money myths, check in with our course, Pay Yourself First, and get started understanding how you can win with money, getting control of your finances, getting all the money back that you ever put in, as well as utilizing that for the future for your family and build some big wealth. So if you have not yet started our crash course, ask us for access to our crash course, get some of our intermediate level courses as well, and we're going to help you crack the code to cash flow for yourself.